Hi everyone, it's Chat about another video. Today I'm going to be doing a stock analysis on Qualcomm. Released some interesting news today which I'm going to talk about in a minute. Fantastic company to own over the long term. It's best known for making 5G and 4G chips. It's a semiconductor manufacturer, but it focuses mainly on wireless technology, which is about 80% of the business. Pays a nice 2.3% dividend yield that has been growing over the long term. P of around 13 on a trailing basis right now. Looks exceptionally cheap, right above his 52-week lows of $118. It's around $130 now. Down significantly year to date, but about the same as the Nasdaq, so not ridiculous losses. I want to figure out if this company's a buy, a sell, or a hold at these prices. The story that came out this week was that a latest survey from an analyst from TF International Securities wrote that Apple's iPhone 5G modem internal business seems to be failing. The development is not going to plan, and they believe that Qualcomm will remain the exclusive supplier for 5G chips until the second half of 2023's new iPhones, with 100% supply share. So Qualcomm was previously guiding for just 20% supply share. This is absolutely massive. It's been known for a long time, since Apple bought Intel's modem business in 2019, that they are looking to do internal development. It's more a matter of time. In this time, Qualcomm has been trying to diversify its revenue outside of purely wireless handsets, which is doing a decent job of working on self-driving cars, working on just getting their chips inside cars as an example. But this is fantastic news for Qualcomm. Even though it's attempting to diversify, it's a massive win for the business, a huge contract that should see its guidance significantly rise in the future because they're going to get a lot of supply share from Apple. Forgetting about that news for a second and looking at the most recent quarter, this is a business that is absolutely firing on all cylinders. $11.2 billion in revenue for the most recent quarter. That's good for 41% year-over-year growth, which is just fantastic considering this is a nearly $150 billion business. This growth at this scale is truly tremendous, particularly for the valuation it's trading at. Decent earnings per share growth overall. For the Qualcomm CDMA technology section, or QCT, that's basically the CDMA wireless products, 80% of the revenue. $9.5 billion in revenue, so it's around 80% of the business. 111% earnings before tax increase year over year for 35% margin, significantly above guidance, and just getting really strong. The earnings before tax more than doubled year over year in 6 out of the last 7 quarters, which is super impressive. The other main section of the business is the Qualcomm technology licensing, which is around 19% of revenue. It's obviously much higher margin because it's essentially their IP being used by other companies. They're licensing that technology to other companies, and they're picking up extremely high margin revenue for that. They have a 73% earnings before tax margin, far above the midpoint guidance. $1.6 billion in revenue. Again, not tremendous growth year over year, but still chugging along and being nicely supported by the CDMA technologies revenue. This is a strong quarter on all fronts. 41% revenue increase year over year, as I mentioned, 68% earnings before tax increase, and 69% earnings per share, all on a non-GAAP basis. Really excellent for this scale. I can't stress this enough how strong this growth is for a company at this scale, with, of course, the supply challenges that have been in place this year. The CDMA technology segment is by far the most important section of this business. You can see the revenue broken down into 4 streams. Handsets provided the most revenue by far, $6.3 billion, up 56% year over year. You can see how they have increasingly tried to diversify and how that is paying off now. Importantly, it's not just iPhones, this handset revenue, so it's not going to go away anytime soon. They're a key partner for Samsung and are in the current era of the Samsung Galaxy, so this revenue is not going to go away by any means, but with Apple it's going to dramatically increase because that supply share of 100% and is not going anywhere anytime soon, or at least until half to 2023 at current estimates. RF front end up 28%, that's $1.2 billion of revenue. Automotive, which is a big growth area for this company, up 41%, getting some nice traction there. Got to remember that the automotive industry is really struggling to get cars out the door at the minute, so that's tremendous numbers. And Internet of Things up 61% to $1.7 billion. This has really been the growth engine for this company outside of handsets, and it's impressive to see this continuing a nice run rate. Moving away from the business and now looking at the stock, some really nice valuation metrics here. Trailing PE ratio of 13 and a forward PE ratio of just under 10, both far below the S&P 500 averages, and a very good price for Qualcomm historically, but obviously this doesn't tell the full story. PEG ratio of 0.62, far below that one value that I consider to be cheaply valued to be kind of bargain territory. That is a very good value. Shows that the future earnings growth is not being priced in effectively at the moment. The one wrinkle for this company is price to free cash flow. Free cash flow has not been consistent over the long term and will decrease slightly this year. And that is to be expected. Many companies are experiencing this. There's a lot of economic challenges going on. But again, it's still in a reasonable region. Price to free cash flow of 20 is not ridiculous and far from overvalued in my opinion. Looking at some balance sheet and profitability metrics, the cash set ratio of 0.74 is not ideal here. I'd much prefer this to be above 1 and is not a great comparison versus Qualcomm's history. This is quite a low number and they're taking on a bit more debt with a bit less cash than I would like. They are a relatively acquisitive company, so cash does occasionally get used up, but I think this is well covered by free cash flow, so I have no real concerns here. Debt to EBITDA of 1.04 is some of the highest in this company's history, and a 23 interest coverage, meaning they could pay off 23 years of interest with just this year's EBITDA. I'm not overly concerned there. Altman score of 5.37 indicates this company is safe from financial distress in the short term. So this balance sheet, while not incredible, doesn't worry me whatsoever. On the right hand side, you can see some absolutely tremendous metrics. Gross margin of 58.51%, slightly weakened versus historical values, and that's because costs are going up industry-wide, economy-wide, but not too much of a concern. Getting this number above 60 will be fantastic, and they have been there in the past. An operating margin of 32.65, again, really, really strong. This fabulous model this company has used is working really well for them, and that translates to a net margin of 28.42, which is very, very strong. Even for the semiconductor industry, this is absolutely fantastic, meaning they get 22.42 cents for every dollar of revenue straight in the back pocket, which is outstanding. Return on equity percentage, 111.11%, some of the best numbers you'll ever see. Return on asset percentage of 27. It's a relatively asset-light company for this realm, and this is shown in its excellent return on assets. Return on invested capital of 40%, absolutely outstanding. Some of the best numbers you'll see for a company at this scale. This is a company that continually returns value to shareholders in the form of stock price gains, in the form of growing the business, and in terms of the dividend. Final stage, of course, is to work out a fair value for this company, and this is where it kind of falls down because the free cash flow has been spotty. You can see the annual year ends of the past 3 years. September 2019, $5.25 per share. Next year, $3.84. Next year, $7.53, and this year, $6.30. So, of course, free cash flow is going to be expected to be weak in this current economy, but it's only gone up over the last 10 years, 5.5% on a compound annual growth rate. Over the last 5 years, much more impressive, 12.3%, and this is kind of where I'm leaning towards. I think it'll grow roughly in line with revenue, so I'm putting into my model 10%. That corresponds with the 10-year growth rate of 9% for revenue, 5-year of 13%, and I'm expecting this company's growth rate to accelerate going forward because they're continually knocking it out of the park in the last few quarters. So using this, which I think is relatively conservative, you can argue the toss on that in the comments. 10% growth rate over the next 10 years for free cash flow, 4% terminal stage growth, and 9% discount rate corresponds to long-term returns of the stock market. This gives a fair value of $120, which is right about where the yearly low was, slightly below today's stock price of $130. But I consider this to be within the tolerance of where this is a relatively okay valuation to pay. Of course, we would like to pay under that, and perhaps the stock will continue its yearly decline. But I wouldn't be opposed to anyone saying I'm buying Qualcomm at 130 because I think this is an okay valuation for this company, just not absolutely dirt cheap. I've barely even mentioned one of its more attractive qualities, the dividend, which is now at 2.28% on a forward basis with an under 25% payout ratio, 5-year growth rate of 5.25% compounded, and 19 years of dividend growth, not long before this company hits dividend aristocrat status, which I have no doubt that it will on its current trajectory. This is a relatively rare opportunity to pick up Qualcomm at a severely depressed price for $130. It was not so long ago this was $180. That's a PE of less than 20 even then. I don't think this is dirt cheap as looked from my fair value calculations with what I feel is a relatively conservative free cash flow growth of 10%. This company is just below its, or just above its fair valuation at $130 compared to $120. I think this has fantastic growth opportunities. I think keeping the iPhone contract for a bit longer to provide free cash flow for it to move into invest in other segments of the business and continue to grow and diversify, it's an absolute boon for this company. I think it'll be a fantastic stock to own over the next 5, 10 and 20 years. I don't think 5G, 6G, 7G, these are things that are absolutely necessary to the growth of the economy and necessary to consumers. And Qualcomm has only ever succeeded in this regard, in increasing its market share and gaining great IP. So I don't think this is going to end anytime soon. Of course, this is just my opinion. You should let me know in the comments what you think. Let me know what you think about Qualcomm going forward. Let me know if you think it's a buy, sell or hold. I'm going to hold off for the minute because I think I can probably get it around my fair value calculation in the near future as the market continues to decline. But again, that's just my opinion. I'm not a financial advisor. If you want financial advice, you speak to a registered financial advisor. Let me know in the comments what you think. Like and subscribe if you're enjoying the content. I'll see you again next time.